Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize both how you view our presentation and how you interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the file folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, in order to receive CPE credit, you must complete our attendance sheet, available in the file folder icon at the bottom of your screen. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. We'll email a copy of your PDF certificate in 2 weeks if you can't download it today. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning and welcome to today's webcast, Accounting and Tax Update for Cooperatives. I'm happy to introduce today's speakers, Eric Kreinert and Kadeep Dhaliwal. Eric has worked in public accounting since 1997. He is experienced in tax planning and consulting for large partnerships and corporations in the food and agriculture industries, but his specialty lies in cooperatives. He provides services related to patronage philosophy and formulating patronage allocation programs based on book, tax, and hybrid programs, equity planning, mergers and acquisitions, joint ventures, and other combinations, non-qualified equities, and domestic manufacturing deduction and taxation. Eric is currently the Vice Chairman of the Tax Committee and a member of the National Board of Directors for the National Society of Accountants for Cooperatives. Kadeep is a partner at Moss Adams and has provided auditing and consulting services since 2005. His main focus is on agricultural marketing and supply cooperatives. He is the past president of the Far Western Chapter of the NSAC and a current member of the NSAC, AICPA, and CalCPA. And we're going to kick today's presentation off with our first polling question, which is, what issue do you think could potentially impact cooperatives the most in 2017? And your options are the election outcome, proposed Section 385 regulations, market volatility, revenue recognition. And I'll give everyone a few moments to respond. To participate in the polls, please click the button next to the answer you choose and hit submit. And let's go ahead and take a look at our results. And Eric, I'll pass the line over to you to get us started.
All right, thank you very much. Good morning, everybody. Looks like we've got market volatility taking the lead on our revenue recognition, and I kind of agree with that. We've seen a lot of changes in prices for a lot of commodities over the last year, and that has a huge impact on farmer cooperatives and obviously their farmer members. The election outcome is also something that will greatly affect things, and I, for one, wish we could hit the reset button and go back to January and restart this whole thing, but we are where we are. So for today's agenda, I'll be taking the first half of this session, talking about the tax updates. We'll go through some court cases, briefly about the IC DISC, non-qualified patronage, and then some private letter rulings that were issued over the course of the last year. Following that, K-Deep will give us an update on some changes to GAAP accounting, revenues from contracts, simplified inventory balance sheet, and the lease accounting, which is finally coming to fruition after a number of years of talking about it. First court cases I want to talk about are three of them that deal with DPAD. DPAD has been around since 2004, and we are finally kind of getting to the point where there's been some court cases regarding DPAD. Some of them have already been settled, and they're related to private companies. There's the gift basket case and the dosage of medicine case. But there's three cases out there that deal with co-ops, and specifically the issue of, do cooperatives have to provide or do two separate DPAD calculations, one for their patronage activities and one for their non-patronage activities. Little background on DPAD is it's the domestic production activities deduction. It is a limitation, or it's a deduction that is 9% of qualified income or 50% of wages. And the lower of those two numbers is the deduction. The history, in 2010, the IRS changed the instructions to Form 8903 and included some language in there for co-ops that they have to do two separate calculations, and that they have to add a white paper attachment to their tax return showing those two separate calculations. Pretty much since the first inkling that cooperatives had heard about that, most objected to it, including Growmark and AGP. Basically, the issue there is if co-ops have to do two separate calculations, we end up moving wages and income between patronage and non-patronage. And usually what happens in a two-calculation scenario is that the overall deduction is lower than what it would otherwise be if it was just done on a one calculation. And the reason for that is typically for most agricultural marketing cooperatives, the patronage part would be limited to the amount of allocable wages, or 50% of the allocable wages, and the non-patronage part would be limited to 9% of qualified non-patronage income, with the effect of reducing the overall deduction. If it's done at one calculation, all of the wages would get thrown in, all of the income would get thrown in, and then you would do one limiting calculation, i.e. is 50% of wages higher or is 9% of qualified income higher, versus the two-part calculation. So Growmark and AGP both had this issue brought up during audits. I believe AGP's was an amended return, whereas Growmark's was on an original return. Both had done one calculation for their patronage activities and their non-patronage activities, and then calculated what the IRS considered to be a larger DPAD deduction. The secondary issue in both of those cases then is once you calculate that larger DPAD deduction, co-ops are faced with the choice of, do they keep it at the cooperative level and use it to offset their tax, or do they pass it through to their members? In both cases, AGP and Growmark kept some of the DPAD at the co-op level and used it to reduce their non-patronage income. The IRS has taken the position that Farm Service limits a co-op's ability to do that allocation and to take what would otherwise be, in their mind, be a patronage deduction and allocate it towards non-patronage. They believe that the Farm Service court case that was decided in the early 80s has a direct impact on domestic production activities deduction, which came into effect in 2004. The regulations and some legislative history make it clear that most other multi-company taxpayers do one calculation, and that can be seen in both consolidated corporate rules, affiliated group rules, and even simply a husband and wife who both have independent businesses, one of which could make a whole lot of money and the other one of which could have a whole lot of wages. As long as they're both doing qualified production activities deduction, they do one calculation instead of two separate calculations. And so the IRS's position that co-ops are different, just doesn't seem to hold weight in view of all of those other factors. And then the allocation of the deduction towards non-patronage, again, is one that does not hold a whole lot of weight. Farm Service was a court case that dealt with actual economic deductions or losses and basically decided that the co-op could not apply those patronage losses towards non-patronage income. But DPAD is not an economic deduction. It has, it's never going to get turned to cash. It doesn't result from writing a check to somebody. It is purely by the grace of Congress that there is this deduction allowed. And it's more akin to a credit. And when we start to look at and analyze, what can be done with this deduction, we can allocate it to our farmer members. If for whatever reason those farmer members had losses in the year received, but they had wages from working in town, or their spouse worked in town, or interest or dividend income, they could use the deduction to reduce those other non-farming activities. And so that it seems logical that a cooperative should be able to use its DPAD deduction against its non-patronage activities. Overall, it's still just reducing one layer of tax. It's just depending on whether that's done at the co-op level or at the farmer level. As a planning idea here, I would advise any cooperative that has historically done their calculation based on the two parts that the instructions dictate, or had not allocated potentially some of their excess DPAD towards non-patronage income. I would recommend that you consider going back and amending those returns. That would preserve your rights to get refunds if these two court cases for Growmark and egg processing turn out favorably. Both cases have been tried, and they are going now through the briefing process in tax court. It's anticipated that we've probably got another year to 2 years before we get any type of resolution from the court as to what their decision would be. And it's likely that there would be appeals that would follow after that. So we are a long time in running in terms of when we'll have a final decision on this. The other court case of interest is South Central FS, and it is currently pending settlement. It was supposed to go to trial last month, but instead they've reached a settlement agreement that is currently being drafted after verbal commitments to both sides. The issue there was, can a cooperative have a per unit retained paid in money if that payment was made by an LLC that was taxed as a partnership? And the facts there were that South Central and some other cooperatives got together and contributed their grain assets to a grain marketing LLC. That LLC was set up to buy grain directly from the farmer members of the various different co-ops, as well as non-members, and then store, handle, and market that grain to other third parties that were the grain buyers. South Central took the position that payment was made on their behalf as almost like an agency relationship, and deemed that payment that the LLC made to its members as a per unit retained, and therefore calculated its DPAD, assuming that it didn't have a deduction for cost of goods sold related to those purchases. The IRS disagreed, and appeals and court cases followed. Like I said, there's a pending resolution there, and we'll talk briefly in a few slides about a private letter ruling along those same facts. The other interesting court cases that are out there, and this is present both in Growmark as well as a secondary or a different issue, South Central, and Sunoco. Sunoco is a large public company that sells a whole lot of fuel. But basically the issue here has to do with two chief counsel advices that were issued in 2013 and then 2014. And I apologize, I think the case number or the chief counsel advice number on that second one should be 2014 instead of 2013. But in November of 2013, the IRS issued the first chief counsel advice, and they determined that the 6426 and 6427 payments were not to be included in gross income. And just a brief history here. This is Code Section 6426A covers all of the or most of the credits related to fuels. And so there was an ethanol blending credit. There currently is a biodiesel blending credit, and it also includes alternative fuel, and this is where most co-ops have the propane credit. So all of these credits are encompassed into this 6426 code section, and it's a difficult read, but basically it's 6426 credits are first required to reduce your regular fuel excise taxes under 4081 or 4041, and then to the extent that there's anything left, you can request refunds under 6427. These rules are made even more difficult by the fact that Congress has historically let these provisions expire and then retroactively put them in place late in the year, which means that most co-ops were asking for refunds under the 6427 provisions. So the first ruling said, well, it's not includable in income, and so the result was that if you were a mixer of biodiesel or a user of propane in your operations, normally when you got those credits, you reduced your cost of goods sold, or if it was the propane credit, you might have reduced some of your warehousing expenses. But for tax purposes, they were not taxable, and so it created a permanent difference, a increase to cost of goods sold or an increase to your warehousing expenses that would dramatically reduce your taxable income. A few months after that first one was released, the IRS issued that second chief counsel advice as a clarification and determined that, no, what we really meant to say was that your excise tax credits, or the credits underneath these code sections, first reduce your liability for excise taxes, and then to the extent that you didn't use it to reduce your excise taxes, you could have a book tax difference. Everybody that I'm aware of that has read that second one has not agreed with it, and lots of cooperatives and lots of other refiners and fuel companies have gone out and amended returns to basically take the position that those credits are not includable in taxable income. And as you can see from that headline that I found while searching on Google, the dollar amounts in questions are not de minimis. Sunoco is looking at $300 million, and I know that these other co-ops, these have been substantial tax savings, and so we're all interested to see how these cases are going to turn out. Other cases that we're aware of in the cooperative area, there's some Southeast electric co-ops that have been sued by members for not paying capital credits in a timely manner. I don't know all the facts regarding these, but I think it's a good thing to kind of highlight and realize that boards of directors typically the bylaws give the board of directors a whole lot of discretion about when and how to redeem patronage credits or allocated equity or whatever you may refer to it in your particular bylaws in your co-op. A lot of discretion about when to actually redeem those credits. And as a result, they can sit out there for quite a long time. It is not uncommon to see co-ops that have patronage credits that go back 20 to 30 years, and I even had an experience working with one that went back 40-some years, close to 50 years. The real question is, if we're not redeeming those quickly, what are we, quote-unquote, doing with the cash? And to the extent that we're using that cash to further our cooperative purposes, typically our members don't have any concerns. But if we go out and use that cash to invest in non-patronage activities that don't benefit the members, there's plenty of potential for those members to raise questions and in this particular case, start some court cases to demand that the co-op redeem those prior credits. Similar situation with Calcott. In this particular case, the co-op had some non-member business that resulted in a substantial loss. That loss was allocated to the members in terms of a reduction in their patronage or their net proceeds from the sale of the cotton. And as a result, several members have sued Calcott to recover those reductions in their payments as a result of those non-patronage losses. And the last one that I'm aware of is a worker co-op that made payments to its members in the nature of per unit retains, and had subsequently or made those payments while it was insolvent. Subsequently, the creditors are in the process of bringing suit to try to recover some of those payments, and so we'll see how that one progresses. But I think the most important takeaway here is to make sure that we are looking at our bylaws and making sure that our bylaws are up to date, because a lot of these issues can be avoided if we keep our bylaws up to date. That brings us to our next polling question. If your co-op exports something internationally, are you currently taking advantage of the IC disc? We will take just a minute or two or a few seconds to let everybody answer.
And just as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. This is our second question.
Yeah. Emily, let me know when it's time to proceed.
Will do. Let's go ahead and take a look at the results here. Eric, back to you.
All right. Looks like a lot of co-ops don't export anything internationally. And I'm surprised by this number, but 13% are actually doing it. I am aware of several co-ops that are utilizing the IC disc, but I'm surprised by that high of percentage. So that brings us to our next slide, talking briefly about the IC disc. IC disc is Interest Charge Domestic Incentive Sales Corporation. It's basically again another function of Congress to incentivize U.S. exports. What it does is allows companies that are in the exporting chain, whether you are the direct exporter or even the supplier or a wholesaler to an exporter, you could qualify as well. But if your product is exported, you can calculate a commission to a related corporation, which is set up as an IC disc. That commission is a deduction for the main company. It's income for the new sister disc company. But because of the special disc rules, the disc company does not have to pay any income tax on it. That disc company can then turn around and issue a qualified dividend out to the shareholders of that disc company and as a result, you have the opportunity to greatly reduce taxable income at the taxable entity level and pick it up as qualified dividends. So we have basically a rate arbitrage of taking the max 39% tax rate down to 23.8%, and so a pretty substantial savings. For cooperatives, they're not able to benefit from it directly. They have to set up the sister company that is the DISC, and then they typically have to set up a trust or a LLC taxed as a partnership to be the owner of that DISC and allow for special allocations of that dividend back to the patrons on a patronage basis. For co-ops to do it, obviously, like most things that co-ops get involved in, it is a function of size and economies of scale. If the co-op sets this up, that means that all of the individual members don't have to set up their own IC DISC, and so there's plenty of administrative savings that can be had if the co-op sets it up. The other benefit is that there's some old rules out there relating to sales of fungible products that can't be commingled. And so if you're corn or soybeans or almonds or all kinds of other things, typically when you deliver that to a co-op, it's going to get commingled with all the other products from all the other members. And this old revenue ruling says that you can't take the IC DISC benefit if you don't know for sure that your product has been exported. Most entities have taken a position that, well, everybody's a proportional share got exported, but that is specifically what this rev rule tries to avoid or say is not allowable. So if the co-op sets up the IC DISC, then it knows what's exported and doesn't have to worry about this rule because it doesn't apply to their situation. The other difficulty for co-ops is kind of how to calculate. There is a part of the commission is either a 4% of whatever the export sales were, or the way to get the maximum deduction is typically using another provision that allows for the commission to be 50% of the export profits. And that could be a substantial number. And more importantly, it could be a substantial number if we don't include per unit retains in the cost of goods sold, similar to how we calculate DPAD. There are some other rulings from the 70s and early 80s that make it pretty clear that co-ops don't have to include their patronage dividend deduction in the calculation, but they are very ambiguous about if you include the per unit retains in the calculation of that 50% of export profits or not. And, if those things are not in there, it's a substantially larger deduction. And it also has impacts on the farmers and what could possibly happen there, because if they're not including those per unit retains in income and it goes back out to them as a qualified dividend instead of a normal check for whatever their commodity was, it's likely that a lot of farmers will be showing some losses on their Schedule Fs and a whole lot of income on their Schedule Bs as qualified dividends. NCFC has taken the lead in trying to address a lot of these questions and has had several meetings with the IRS and Treasury and has gone as far as to submit some sample rulings to the IRS and Treasury for consideration in hopes that prompts them to actually take a look at this issue and address it sooner rather than later. With the election and potential change of administration or actual change of administration coming up, it's hard to tell whether this is going to gain traction or not. Those co-ops that do have export sales, they really should be thinking about whether they want to export or not. I'm going to skip over this slide in the interest of time, talking about non-qualified. And instead, I want to get to the recent private letter rulings. At the end of last year, the IRS released private letter ruling 2016-01-004. basically, it was the same or similar facts as that South Central case, but the co-ops and the LLC in this case decided to set it up so that the co-op was the direct payor of the grain, using the LLC or using the co-op's bank account, but the LLC as the authorized agent to write checks or initiate wire transfers on those payments directly to the farmer. And the IRS ruled that if the co-op made the payments, that those payments would be per unit retains, and so that had a significant positive impact on that particular LLC. The other thing that this ruling did very well is help highlight the rules regarding how LLCs are to be treated as patronage or non-patronage on the co-op's books. And it made very clear some old rulings that weren't quite so clear, that if your members' proportion of the total activity of the LLC is greater than your distributive share of the income, then 100% of your distributive share of the income will be patronage sourced. If your members' share of the total activity is less than your distributive share, then you basically pick up the proportion that your members contribute to the total as patronage, and then the rest of it as non-patronage / investment income that would be subject to tax and not eligible for the patronage dividend deduction. The last two rulings were very interesting in that they dealt with an issue that was kind of not exciting, and that is losses as it relates to co-ops and what to do with them. And the reason I decided to highlight them here is that the first one did something that was a little bit unique in that the co-op owned an LLC. It was going to sell that LLC. It was likely going to sell that LLC and that loss, or at a loss, and that loss was going to be going to be a capital loss. And if you remember, there's some special rules for corporations that we're only allowed to take capital losses to the extent that we have capital gains. And capital losses have a shorter carryback and a carry forward period of only 3 years back and 5 forward. And so the co-op in question here was concerned about, we may not have capital gains to offset this with, what can we do with it? And they developed a plan to basically cancel some prior allocated equities that they had, and in a sense pass through or push through this loss to the members in the form of cancellations. And that's significant because there was a prior Senex court case that concluded that the sale of stock was capital regardless of whether it had a patronage purpose or not. And so, the co-op in question here wanted to make sure that they didn't get limited or were able to actually use that loss to offset. And so the conclusion was that the loss was a capital loss, and to the extent that the co-op canceled some prior patronage, that they were able to reduce the amount of that loss by the offsetting of the patronage cancellations. And the last private letter ruling that we'll talk about here was 2015 36011. This was in my opinion, a pretty good ruling, and because it went through a lot of history associated with losses and some prior rulings, some prior court cases, and really provided a lot of clarity about how NOLs interact with patronage dividends. And basically, we are allowed to calculate our patronage sourced income in years after the NOL, calculate how much patronage to pay out based on bylaw provisions, and then whatever is left in terms of patronage income, you can use the NOLs to reduce that income and reduce tax down to zero, as opposed to having to use NOLs first and then calculate patronage second. And again, this is an area where I would really highlight that we see a lot of deficiencies with co-ops. I'm sorry, I didn't mean to advance the slide just yet. In the bylaws that don't address how to deal with losses. And if there's one takeaway from this is make sure you're reading your bylaws, see if there's a provision in there for losses, and if there's not, I would highly recommend that you bring this as an item of attention for your board of directors to address in the near future. So with that, here is our third polling question. How many of you have read and understand your cooperative bylaws?
All right, and another reminder
And
that
Emily,
for those of you that would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts at the bottom of your screen. We'll also be sending the slides via email after the webcast. I'll give everyone a couple more seconds for the polling question. And let's take a look at the results. Eric, back to you.
All right. We are pretty equally split between I have read and understood, and I have read but don't understand, and I haven't read at all. And I would highly encourage everybody to get up in the category number one. Read those bylaws early and often, and make sure you understand them, and make sure you're getting clarity with any questions that are out there. There's lots of confusions in bylaws. They're written by lawyers. It's sometimes hard to interpret. But make sure you know and understand them, and that you're following what they say. And if they don't apply to your co-op, at this day and age, that you consider amending those bylaws to get them up to date. I think we just talked about all of that right there. And so with that, I'd like to turn this over to Deep to talk about the gap update.
Yeah, thank you, Eric, and hello, everyone. Good morning. I'm going to switch gears a little bit. Like Eric said, we're going to switch over and talk about the world of GAAP and what's going on in accounting. The last couple of years, what the FASB's really been doing is a push to simplify some of the literature and switching from a public company mentality to a private company mentality, and saying, what are the standards and how do they impact private companies, and how can we rewrite some of these standards so that they're more easier to implement for private companies. So the first ASU that I want to cover is revenue from contracts with customers. So this came out in May of 2014, ASU 2014-09, and it's really the point of this update is to make a more uniform way of recognizing revenue. The previous revenue recognition or GAAP standard was fairly broad in terms of how companies are to recognize revenue. It was based on when revenue is realizable or realized, you would recognize revenue. And that's a very vague statement and doesn't really help numerous types of industries interpret, how do you do that? So the point of this is really to simplify, clarify, and bring one converged standard. So this was a pretty drastic change, and like I mentioned, it came out in May of 2014, and the whole difference between current GAAP and new GAAP is there's a 5-step process of now recognizing revenues. The first step is you would identify a contract with a customer, then you would identify performance obligations under those contracts, and you'd have to determine what the transaction price is, and then allocate that transaction price against those various performance obligations. And as you now satisfy performance obligations under the contract, that's when you were to start recognizing revenue. I know that seems like a lot of steps and may sound like it actually complicates things, but if you step back and think about it, we've all got contracts in our businesses, and we enter into sales contracts with customers, and ideally there's going to be a drawn-out obligation to perform under that contract. The standard really says is you identify those obligations, come up with what the true price of the transaction is, and as you ship your goods or perform your goods or services, you recognize that revenue as you go. And the bigger change for many co-ops, I think, is just going to add more disclosure requirements. We don't think there's going to be a significant change to your top line, how much revenue comes on your P&L. It's really going to add some additional disclosure requirements. And the whole point is to enable users of the financials to understand the nature, the amount, and the timing of revenues and any uncertainty around revenues. So when this first came out back in May of 2014, there was a lot of pushback from stakeholders, the preparers, practitioners, readers of the financial statements. They basically said, well, this is a pretty significant change and it's going to take us much longer to implement this standard. And so ASU 2015-14 came out in August of 2015. And what that additional ASU does is basically defers the effective date of when this new standard is going to be implemented. So for private companies, it'll be effective for periods beginning after December 15th, 2018, and interim reporting periods within annual reporting periods beginning after December 15, 2019. For public companies, they'll be required to adopt it 1 year earlier, but again, it's pushing it out for private companies. And there's always the ability to early adopt. I haven't seen many people that are jumping for joy about early adopting this one, but that's coming up. ASU 2015-11 is a move to simplify the measurement of inventory. And this is really applicable to any entity that does not measure inventory using LIFO. So if you're using FIFO, then you can adopt this accounting policy. And again, the purpose is to reduce the cost and complexity of how you measure inventory. So the best way to walk you through what all this means is I'll give you an example of how you would value inventory under the old pronouncements versus under this new standard. So here's some facts I've got up on this slide. Assume that you've got an inventory item with a cost of $100. The net realizable value is $105. Your replacement cost is $88, and your net NRV less than normal profit margin is $90. So here's some facts that you'll want to know for this example. So under the current standard, you would compare your cost of inventory of $100 to your replacement cost of $88. So now you can see your replacement cost is less than what it originally cost. So you know there's some kind of write-down that needs to happen, but you've got to do additional analysis to determine what that write-down is. And this is where things get slightly complicated. You've got to assess what market value is, and you say, okay, what is market value? Does my replacement cost exceed my NRV, or is it less than my NRV less an approximate profit margin? And that's your notion of floor versus ceiling, if you remember that from your accounting classes. So you compare your market value to this floor and ceiling. And in this example, you've got to write down your inventory to NRV. So the inventory is written down to $90 basically. So that's a pretty complicated exercise. And what the new standard does is really just removes this notion of lower of cost or market and replaces it with lower of cost and NRV. So under the new standard, assuming your cost was $100 and the NRV is $105, there is no write-down because your cost is still lower than NRV. And this standard is effective for fiscal years beginning after December 15th, 2016, and interim periods with fiscal years beginning after December 15th, 2017. Again, early adoption is permitted. I've seen more people early adopt this one, and the reason being is many co-ops are already valuing their inventory at NRV, so they've been doing this, analysis of lower of cost versus NRV for quite some time. So then it's just mentioning in your footnotes, we've adopted this policy or we've continued with this policy. The next one I want to cover is ASU 2015-17, And really what this is doing is simplifying how you present any deferred taxes on your balance sheet. So under current GAAP, deferred taxes are generally presented as either a net current asset or liability or a net non-current asset or liability. And you would have to go through an exercise to determine which portion of your deferred taxes are current versus non-current, and you would have generally two different classifications there. And if there's any valuation allowance, you would allocate that on a pro rata basis between current and non-current deferred assets as well. Under ASU 2015-17, it does away with non-current versus current. So basically all deferred tax assets and liabilities and any related valuation allowance would be classified as non-current on the balance sheet. One thing to point out, though, is that companies are still prohibited from offsetting deferred tax liabilities from one jurisdiction against a deferred tax asset of a different jurisdiction. So if you've got a federal versus state, you would still separate those and not net the asset to the liability. And this one is going to be effective for fiscal years beginning after December 15th, 2017, and interim periods beginning within fiscal years beginning after December 15th, 2018. And early adoption is permitted on this one as well. I believe it's time for a poll question here. I'd like to know how many of you are aware of the impact of the new lease accounting standards on your companies.
We'll give everyone a few moments to respond here. Just a reminder, once you have completed all of your CPE requirements, you will be able to download a PDF of your CPE certificate from the certification icon at the bottom of your screen. And let's see what everyone has to say. KD, back to you.
Okay, so we're about split right down the middle between how many of you are aware of the new standard and what the impacts will be. And it's interesting. I've actually talked to multiple people in industry, bankers that spend all day reading financial statements, and I've mentioned, hey, are you guys aware of what the new lease accounting standard that's coming down? And the answer is no. Not a lot of people are aware of this, but I think this will be one of the bigger impacts to all of your financial statements. So this has been around for about a little over 10 years. The FASB has been talking about a possible change in the lease accounting standards. And really the driver behind this is the FASB says, well, we think there's a significant amount of off-balance sheet liabilities out there related to these operating leases. They did some study, and it was up in the trillions of dollars of liabilities in the United States that are not on companies' balance sheets because of the fact that they're operating leases and are not required to be on the balance sheet under existing lease accounting standards. And many practitioners thought that they would retire before this new standard was ever enacted. So when it came out this year in February, it was a shock to some people because it's actually happening now. And now people are scrambling to figure out, okay, what are the impacts? How are we going to adopt this? What is it going to do to our financials and our covenants? So this is a pretty significant standard here. And under the new standard, essentially all leases will be now coming onto the balance sheet. So all lease liability, whether it's a capital lease or an operating lease, will end up on the balance sheet. Now, there are some exceptions. So if there's leases that are 12 months or less, companies can make an accounting policy election not to apply the recognition. Basically, it's a short-term lease and would not apply. The other exception is there are certain leases that are excluded from the new standard. I don't think many co-ops will be able to take advantage of this exclusion because you don't see those types of leases out there in the co-op world. And generally what those are is if you've got a lease of intangible assets or you're leasing some exploration rights of natural resources or leasing inventory or assets under construction, those leases don't apply under this new standard. But like I said, I don't think many of those leases are out there in the co-op world. So what's this mean? Under ASU 2016-02, like I mentioned, you would record the lease on your book. So you would have two sides of this. You would record the asset, and you call it a right-of-use asset on your balance sheet. And what the value is really just the initial lease liability plus the payments made by the lessee to the lessor before the lease starts, and any direct costs incurred by the lessee. So now you have what your asset balance is. And now you also get to record a lease liability. And the lease liability is really just a present value of your future lease payments. So you can look at this and say, well, does it really have a net effect? Not really. You've got an asset and a offsetting liability. But where the distinction is how you recognize the expense and the amortization. So you remember a capital lease versus an operating lease. Under the old standard, that language is going away and being replaced by basically a financing lease or an operating lease. And it's important because that distinction is going to drive how you amortize and recognize the expense on your P&L. So under the old standard, a capital lease, very similar to what a financing lease would be if the ownership transfers, if there's a purchase option, if the lease term is for a major part of the economic life of the asset, or if the present value of future lease payments equals or exceeds the fair market value of the asset, that would classify as a financing lease. Now, if it doesn't meet these characteristics, then it's an operating lease. I'll cover why it's important to make that distinction. Under an operating lease, you would take the interest expense and the amortization expense and straight line that over the life of the lease, and that would be one expense item on your P&L, on your income statement. So you would have an interest expense and amortization expense bunched up into one and call that your lease expense and recognize it straight line. If it's a financing lease, however, that lease, the expense is going to be front-loaded, so very similar to a current capital lease where you have an expense that basically declines over the years of the lease. And the other distinction is here, the interest expense and amortization expense are recognized separately on the P&L as two different line items. So this one's coming up effective for fiscal years beginning after December 15th, 2019, and interim periods with fiscal years beginning after December 15th, 2020. Early adoption, again, is permitted. The question may be, well, what do we do right now to get prepared for this? The key is really just to understand and evaluate the effects of this transition. If your company's, if your accounting department's big enough, it may make sense to form some kind of lease implementation group or a committee, where you go out and you look at what are existing leases, how many operating leases do we have out there, and really evaluate the impact on the financial statements, and start talking to your lenders about what's this going to do to our covenants. Do we need to revisit some of our covenants so that we're not all of a sudden out of compliance because we've got a new standard that comes across? And so that covers the gap update, and I'll pass it over to Emily.
Great, thank you, Katie. We do have a couple of minutes for Q&A. If you have a question that you would like to ask either of our presenters, you can type that in the Q&A box and hit submit. The first question we have is, we've been hesitant to create an IC disc because we don't want to be flagged for an audit. Is this a red flag for the IRS?
There's no really way for the IRS to tell whether you have a disc in play or not. If you're a particular co-op, obviously they're going to see a new disc return for the new entity that's set up, but it is not a inherent red flag, if you will, for the co-op itself. Like I said, it's perfectly legitimate for a co-op to have an IC disc. The real question comes down to how you calculate that commission expense. And there's safe ways to do that, and then there's more aggressive ways to do that. And so you just need to really evaluate where you want to be on that spectrum of safe calculations versus aggressive calculations.
Thank you. Next question is, do you have any suggestions for improving the effectiveness of our audit committee?
Yeah, I got one suggestion there. I would say the biggest difference I see in audit committees that are really effective versus those that are just kind of going through the general, just doing things as they always are doing it, is adding an outside party to your audit committee. So whether that's a CPA or an attorney or somebody in industry that's knowledgeable that can come in and be on the committee and add some third-party perspective, that's where I see the biggest bang in terms of an audit committee. Eric, I don't know if you have anything to add there.
I guess the only other thing I would add there is allow that audit committee to have a separate meeting independent of a normal board meeting, and allow them time to bring in some outside counsel to provide them some education as to their roles and functions, and possibly updates to things like we heard here with new tax and accounting pronouncements. The more educated that audit committee is, the more effective they're going to be.
Great. It looks like we have one last question. In terms of tax planning for 2017, is there anything that I should be planning for or aware of?
It's wait and see. There was a lot of the extenders that happened last time were made permanent, and so we don't have a whole lot of surprises. We know how long bonus depreciation is going to last. We know how long 179 depreciation is going to last. One thing that is set to expire, as we talked about earlier, was those fuel credits, and one of the things that's about to expire is that biodiesel blending credit. I know there's some things out there in Congress, proposals out there to get that extended again, but we're really in a wait and see. Beyond that, I think the most important thing for co-ops is to continuously spend time looking at their bylaws and making sure that those bylaws are up to date and internal policies are actually following what those bylaws say.
All right. Well, that was our final question. Please feel free to reach out to Eric or Kdeep if you have any further questions. And thank you, Eric and Kdeep, for a great presentation. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive credit, and that can be found in the slide deck and handouts widget at the bottom of your screen. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE icon at the bottom of your screen. Open the icon and click the printer in the lower right corner to download a PDF copy now. I'll keep the webcast console open for a few minutes to give you time to download this now, and a copy of your certificate will be emailed within 2 weeks should you have any technical difficulties. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.